Coinbase's billion-dollar secret nobody talks about. In the first video, I broke down Bitcoin, how it works, how there's no company, no CEO, nobody in charge. The whole point is that it's decentralized. Nobody owns it. Last week, we looked at FTX, a company that tried to sit at the center of that system and imploded. This week, I want to look at the other side of that story, and then I started thinking about Coinbase. Because Coinbase made $3.1 billion in revenue in 2023, selling something nobody owns, through a platform that a lot of people treat like a bank, even though it's not one. That tension between what crypto is supposed to be and what it actually became, that's what this video is about. Because Coinbase isn't just a fee machine, it's a much weirder, more interesting business than that. And understanding how it makes money tells you a lot about where the whole crypto industry is actually heading. If you've bought crypto at all, especially in the US, there's a decent chance you did it through Coinbase. It's the biggest crypto exchange in America, over 100 million verified users. It was the first major crypto company to go public on the stock market. But here's what most people don't think about when they're tapping buy. Every time you make a transaction, Coinbase takes a cut. Every time the market goes crazy and volume spikes, Coinbase wins. Every time you just leave your crypto sitting there, Coinbase might be quietly earning off of that too. The business model is more layered than it looks, and it's worth understanding. Not because you're going to invest in Coinbase stock, but because understanding how the infrastructure of crypto actually makes money tells you something real about the industry you're participating in. So let's follow the money. Coinbase is not a blockchain. That's the first thing to understand. Bitcoin runs on a decentralized network of thousands of computers. That part has no owner. Coinbase is a company that built a front door to that network. Think of it like this. The internet doesn't have an owner, but companies like Google and Amazon built businesses on top of it. Coinbase did the same thing with crypto. You want to buy Bitcoin? You could, in theory, do that directly. Set up a wallet, find a peer, settle a transaction on-chain. Most people are not going to do that. Coinbase makes it as easy as buying a stock. You create an account, connect your bank, and tap buy. They handle everything in between. That convenience is the product, and like all convenience, it comes with a price. When you buy crypto on Coinbase, a few things happen at once. First, Coinbase charges you a fee, usually somewhere between 0.5% and 3.99%, depending on how you pay and which product you're using. That's the most obvious revenue stream. But here's something most casual users don't realize. When Coinbase shows you a price for Bitcoin, that price already has a small markup built in. It's called the spread. You're not just paying a commission, you're also paying a slightly inflated price on the buy side and getting a slightly deflated price on the sell side. It's similar to how a currency exchange works at an airport. The rate you see is never quite the market rate. That difference is profit. So before we even get to the other revenue streams, just the act of buying and selling on Coinbase involves at least 2 layers of charges, not one. So here's where Coinbase gets interesting as a business. Because it's not just fees, there are 4 main ways it makes money, and they're pretty different from each other. The first is transaction fees. This is the one everyone knows. You buy or sell crypto, Coinbase takes a cut. In 2021, the last big bull market, transaction fees accounted for over 90% of Coinbase's revenue. That's a problem because it means their income is almost entirely tied to how excited people are about crypto in any given month. When the market goes cold, their revenue falls off a cliff. In 2022, after the crash, Coinbase's revenue dropped by nearly 60%. That's not a stable business, and Coinbase knows it, which is why they've been aggressively building the other 3 revenue streams. The second is interest, staking, and custody. Here's the part that surprises most people. When you leave cash in your Coinbase account, US dollars, not crypto, Coinbase can earn interest on that cash. They invest it in short-term instruments. You don't see most of that return. They keep it. It's the same model as a bank, except Coinbase isn't a bank and doesn't have the same obligations. Beyond cash, there's also staking. For certain cryptocurrencies, like Ethereum, you can stake your coins to help run the network. In return, you earn rewards. Coinbase offers to do this for you and takes around 25% of your staking rewards as their commission. The rest goes to you. And then there's custody. Big institutions, hedge funds, ETF providers, corporations need someone to securely hold their crypto. Coinbase Custody does this for a fee. It's the boring, unglamorous part of the business. It's also one of the most reliable. The third is institutional services. Most people think of Coinbase as an app for retail investors, but there's an entirely separate business underneath it, serving institutional clients. Coinbase Prime is a trading platform built specifically for institutions. It offers advanced order types, deep liquidity, and direct market access. Think Bloomberg Terminal, but for crypto. What changed everything here was the Bitcoin ETF approval in January 2024, because Coinbase was named the custodian for most of the major ETFs, including BlackRock's. That means every dollar that flows into BlackRock's Bitcoin ETF is sitting in Coinbase's custody infrastructure, and Coinbase earns a fee on every dollar of assets under custody. When BlackRock's ETF hit $50 billion in assets in record time, Coinbase was earning off that entire stack. That's a very different business from charging someone $2.99 to buy $100 of Ethereum on their phone. The fourth is the USDC deal. This one is the most interesting and the least talked about. USDC is a stablecoin. It's a digital dollar. One USDC is always worth exactly $1. It's pegged to the US dollar and backed by actual dollars held in reserve. Coinbase co-created USDC with a company called Circle. And here's the business model. Every USDC in circulation is backed by real dollars in a bank account. Those dollars earn interest. That interest income gets split between Coinbase and Circle. In 2023, when interest rates were high, Coinbase earned nearly $700 million just from this arrangement. Not from trading, not from fees, from interest on a pile of dollars sitting in accounts backing a digital currency. USDC in circulation peaked at over $50 billion. Even at a conservative interest rate, the math works out to an enormous passive income stream. This is the part of Coinbase that most people have never thought about. It's a stablecoin issuer quietly earning hundreds of millions of dollars in interest while you're busy watching the BTC chart. So here's the thing that I find genuinely fascinating about Coinbase. The whole premise of Bitcoin and crypto in general is that you don't need a middleman. No bank, no institution, no company taking a cut of your money. And yet, here's Coinbase, a billion-dollar company that became the dominant middleman for an industry that was explicitly designed to have no middlemen. There's a real irony there, and I'm not sure it's a bad thing, but it is a thing worth noticing. Because what Coinbase figured out is that most people, given the choice between do this yourself with a hardware wallet and a seed phrase and just tap a button on your phone, they're going to tap the button every time. That gap between what crypto could be in theory and what most people actually want to deal with, that's Coinbase's entire business. Whether that makes them brilliant or parasitic probably depends on how pure your crypto philosophy is. For me personally, I think Coinbase is a legitimate business. I also think it's completely fair to acknowledge that it has the same fundamental risk as any financial middleman. If you keep your crypto there and they have a problem, that's your problem too. The whole not your keys, not your coins thing is real. But as a business, it's one of the more interesting ones I've looked at because it's not one business, it's four bundled together, all depending on whether people believe in this industry long enough to keep participating. That's a bet I find hard to dismiss. Next week, we're going one layer deeper. Coinbase is built on top of blockchain technology. But what actually is a blockchain, and why does anyone need one? It's one of those questions that sounds simple until you try to answer it properly. That's next. If you want to understand the business side of crypto, not just the price, this channel is for you.